Good afternoon, everyone. Thank you for coming to our panel. I think we have Robbie Mitchnick, Head of Digital Assets from BlackRock here. He is someone who needs no introduction at this point, I think. So, Robbie, can you talk to us about BlackRock's digital assets team and how it fits within the asset manager's broader crypto initiatives?
Yeah, sure. Well, we built a pretty remarkable team, and we did it, I think, deliberately in a way that rather than having a sort of big blockchain or digital assets practice off to the side of the org, tasked with, figuring out what to do with this whole space, we deliberately kept it to a small, relatively small, centralized team that then works across our business units. And so that team today, in terms of the centralized digital assets team, is a combination of strategy, client engagement, regulation, product, engineering. But then all the big things that we've done in this space from pretty much day one have included the respective parts of BlackRock where, that initiative naturally sits. So you think about the ETFs, you think about iShares, you think about what we've built from a technology perspective with Aladdin. That's the Aladdin business and engineering team. You think about what we do with Circle and the stablecoin space that runs through our very successful cash management platform.
Speaking of ETFs, the launch of the first U.S. spot Bitcoin ETFs and spot Ether ETFs, those are probably the most exciting crypto events of the year. And obviously, BlackRock's IBIT and ETHA, both are very successful funds. I'm curious, since their launch, how have they been received by investors?
Well, certainly quite well, as you note. IBIT now sits at 24 billion or so in AUM. ETHA, which is of course much younger, sits at just over $1 billion in AUM. And I think, we did know that there was going to be a lot of demand for these. I don't think we knew just quite how enormous, frankly, unprecedented for the ETF space that demand would be. And what's interesting is a lot of it still has been end investor driven, but end investor, of course, can mean anything from sort of small dollar retail to ultra high net worths in multiple cases, billionaires, people holding, in some cases, 100 million plus IBIT positions, right? But we're just starting to see some of that institutional demand actually show up in a little bit more size. We're just starting to see some of the big wealth advisory platforms approve this. And so, despite this sort of historic success, it hasn't been fully open just yet, and we're starting to get there.
I think you noted yourself, IBIT 24 billion, ETHA 1 billion, and I think that's sort of what a lot of investors are observing. Bitcoin ETFs are massively successful, but it seems to be taking a little bit more time or magic for the Ether ETFs to succeed. Why do you think is that?
Yeah, well, I think if you compare the Ethereum ETFs against Bitcoin, the numbers look, perhaps somewhat underwhelming. If you compare them to ETFs in general, then these have been very successful launches too, right? It's very rare that you see an ETF get to $1 billion in AUM in 7 weeks, as ETHA did. In most cases, it takes multiple years to never for a new ETF to get to $1 billion. Now, with ETH, I think the investment story and narrative is a bit less easy for a lot of investors to digest. So that's a big part of why we're so committed to the education journey that we're on with a lot of our clients. And so, you would not expect, you're not going to expect them to ever be quite as large in terms of flows in AUM as their Bitcoin counterparts are, but it's still been a pretty good start.
That's fair. And this is probably more of a ETF nerd type of question, but as reporters, we cover ETFs every day. We look at every single details, and I noticed that IBIT and ETHA tend to trade at a premium than the other crypto ETFs. Why is that?
Yeah, that's true. So when you think about the way ETFs track the value of the underlying, typically they trade pretty close to the true net asset value, but sometimes you'll see premiums and discounts of, 5, 10, 15, 20 basis points, depends on the market and the product. It's accurate to say for a lot of the last 7 months, IBIT and then more recently ETHA have traded at larger premiums to NAV than many of the other products. That's actually, as of really a week ago, has come in. And the reason for that is that out of the gate, we very deliberately had a narrow trading strategy where we only executed through Coinbase Prime, who then has access to multiple sources of liquidity. And we did that for very deliberate risk control reasons, where the integration that we'd built for Coinbase Prime into Aladdin was developed over more than a year. And it was critical for us, before we added any additional trading counterparties, to develop a comparable level of automation and operational robustness in the process for risk control reasons. So that was an approach we took. Some of the other funds, did that, added more kind of right out of the gate. We felt this was the right thing for us and, shareholders in IBIT and the level of institutional robustness that they expect. But now we have built that in, and so there are a broader number of trading counterparties, still very tightly controlled, but that has brought the premium down closer to NAV.
Interesting. One more question about ETFs and we'll move on to something else. We recently saw the SEC approving the listing and trading of options on IBIT, and it seems like a lot of investors in crypto are very excited about that. What's your take on this, and when might we see the options start trading?
Right, so that was one part of the options approval journey. There's still a couple of other steps now that the SEC has approved. So it still may take a little bit of time for us to see those actually launch, but nonetheless encouraging. And, I think if and when, hopefully, we do see those approved, it's going to be great for this market because there's a lot that you can do with Bitcoin in terms of its, quite unique risk-reward dynamics, the positive skewness it's historically exhibited, its volatility, that options can help particularly institutional investors to tailor their exposures a little bit. So if they want to hedge risks in certain ways or certain types of outcomes, options make it a lot easier to do that kind of hedging, which it just helps more capital comfortably come into this market in the way that they want to.
You mentioned education, which is very important for financial advisors and for professionals in the wealth management space to understand before they can recommend a Bitcoin ETF or an Ether ETF to their clients. So I know that you recently authored a white paper about the risk and reward characteristics of Bitcoin, which could be a little bit controversial or different than what the crypto community has historically understood Bitcoin to be. Can you walk us through this?
Yeah, well, I think what's interesting is that when you talk to large Bitcoin holders who've been in this for a long time, I think they almost unanimously are very aligned with the way that we describe it in that paper, which is it's an idiosyncratic thing. It's still early. It's still risky. It's still volatile. But it has its unique set of risk and return drivers that really don't have a whole lot to do with traditional macroeconomic variables or what drives stocks or whatever, with certain exceptions. But generally speaking, Bitcoin has its own distinct set of risk and return drivers. I think when you bundle it unduly, when you extrapolate from it's a risky asset to me and therefore it's a risk-on asset, which is a different concept, you actually undermine its appeal to a lot of investors. And so that's something that will take some time maybe to deprogram, but we think the way that we characterize in that paper, the title of the paper is Bitcoin, a Unique Diversifier. we think that fundamentally is the right way to think about it.
So it's good when markets are hitting all-time highs and Bitcoin is not necessarily moving along with it.
That's perfectly fine, right? Especially you think about some of the headlines that have been moving markets, and you'll see publications that try to link these two. They say Bitcoin is down because non-farm payrolls came in soft, or unemployment, looks, to have risk to the downside, or the ISM manufacturing index. None of those things make any fundamental sense in terms of why they're linked to Bitcoin. We think generally there's about 2 or 3 things a year that really impact the fundamentals of Bitcoin in terms of long-term price. It's hard to, write about those on a daily basis. So we sometimes look to other things happening in traditional markets, but I think that can be a distraction.
That's really something interesting to think about. Another topic that I know a lot of audience wants to learn more about is tokenization, which is a concept that serious people on Wall Street has long supported, even when they were saying Bitcoin is a scam. I'm curious, what is your take on tokenization, and what is BlackRock doing in the space?
Well, we're excited about tokenization. Obviously folks have probably seen some of the stuff that we've done recently in that area. I think tokenization has massive potential. I think some of the hype associated with it maybe outran in the early days some of the reality of what it could be in the short or even medium term. There's a lot of infrastructure maturation. There's some regulatory questions. There's some coalescence by industry players and around asset classes that still needs to happen to really see this start to unfold at scale. But the two are, it's not an either or thing, right? I think that's a mistake that a lot of folks made, some institutions made, is to think of it, you're either on the team crypto or you're team tokenization. And what I think we're actually going to see is that the foray into crypto by more and more institutions is a critical foundational step to ultimately seeing tokenization adopted at scale. Because if you think about it, what's riskier, right? Is it riskier to have institutions deploy, 1 or 2% of their capital into this, novel asset risk profile, or is it riskier to move tens of trillions of dollars of funds and securities onto this new technology paradigm? Well, when you think about it that way, obviously the second one is riskier, right? So the more institutions can get comfortable with blockchain wallets and settling these bearer instruments and operating in the digital assets ecosystem, the more natural it would be to ultimately start to move into tokenization at scale.
I think we've heard BlackRock CEO Larry Fink say things like, eventually everything will be tokenized, or a lot of financial assets will be tokenized. Do you see a future like that for financial markets?
Yes, I think that's a very real possibility, right? And so we think that that's something that even if it's years or potentially decades off, you have to be building for it today, and that's what we're doing.
Got it. And in crypto this year, every participant can sort of notice that it has become an election issue. We have presidential candidates talking about crypto, and the panel before our panel, we have Senate candidates talking about crypto. What do you make of this, and where do you see the regulatory status of crypto to be in the future?
Yeah. Well, I think putting the politics aside, perhaps the most encouraging development of this year has been that there's been an emerging, frankly, bipartisan consensus and recognition that the existing frameworks, such as they are, don't do the trick, and there's a need to develop clear regulatory frameworks to support this asset class and this technology area that allow the U.S., amazingly, despite the U.S. not having really figured it out on the regulatory front for digital assets, is still by far the global epicenter of the digital assets world, no question, right? And so putting the right regulatory framework in place that will enable this technology to be fully harnessed and developed in the U.S. and support the businesses that are trying to build around it in the U.S. is clearly going to be a positive. And there's no one on either side now. I shouldn't say no one, but for the most part, on a bipartisan basis, there's a recognition of that. So I think that's quite encouraging for the prospect of getting something done.
When it comes to regulation, a lot of industry players are saying that there sort of seems to be at odds with things like decentralized finance, which is something that's inherently sort of not to be subjected under regulation. Is DeFi something that Wall Street players like BlackRock can integrate into your everyday practice?
Well, not yet, right? But I think it's something that we, like, frankly, all the largest TradFi institutions, I think, are spending more time thinking about, right? Because it's pretty amazing what this technology can do and some of the products and services that have been built in the DeFi world to date. Yes, there's a little bit of a overhanging question of what would regulation actually look like for this technology where there's no, corporation or centralized actor to actually regulate. And that'll need to get figured out. Some of the sort of AML KYC dynamics will need to get figured out so that institutions can uphold their same obligations as they would in any other market, that's actually possible to uphold in the way they engage in DeFi. But those will eventually get figured out, right? So part of our job is to look further down the track and think about, post resolving those, what can we do, and therefore what should we be doing today?
And I guess lastly, we've talked about DeFi, we've talked about ETFs and regulation. What are some of the other trends in crypto that makes you excited?
Well, that's I think that's the heart of it. When we think about the digital asset space, we think about it in three buckets. That this is from our lens, which is crypto, stablecoins, and tokenization. And so, when you look at what we've done in this space, it maps pretty closely to those three. When you're talking about crypto, it's not just the ETFs, but the technology capabilities that we built with Coinbase Prime into Aladdin. When we think about stablecoins, we're obviously a large backer of Circle. We manage the majority of the USDC reserve, and we've done a lot of innovation work with them. And then in tokenization, we made an investment in Securitize. We've started to, pursue tokenization with them, and that's a starting point for what we think is going to be a really big opportunity for us and for our clients.
Great. Well, I think that wraps up our panel. Thank you for coming to our panel.